Going to provide you a bit of estate planning and advice. So often is the case, we are trying to minimize or eliminate probate tax, that 1.5% tax that I spoke of earlier. And in some cases, it's you're able to eliminate it completely, the need for probate tax, because you're able to and this is often the case with spouses, you're able to ensure that all of the estate assets pass to a surviving spouse without the need to do anything with the will. But the will does confirm that that's the spouse's intention and wish. But sometimes it's the case that making a probate application is inevitable. So what we're trying to do in those cases is just minimize the amount of assets that are actually coming into the estate by using these strategies that I'm about to talk about. So the first is joint ownership. Owning your home with your spouse jointly is a given. It should be done unless there's reasons not to. But joint ownership on bank accounts as well. What joint ownership means is that there's rights to survivorship. So legally speaking, upon the passing of one joint owner, the surviving owner becomes the full holder of the account or whatever it may be, a piece of real estate. Beneficiary designations. So taking advantage of all the beneficiary designations available to you on registered accounts such as RRSPs, RIFs, TFSAs, very important to do. It means that the beneficiary on those accounts will receive the money quicker and it won't be taxed at the estate level. It won't flow into the estate and have to be part of the calculation of that 1.5% tax. Other items I don't have listed on the screen here are beneficiary designations that are given to you through your pension and life insurance proceeds. So if you have a life insurance policy, it's important to make sure that the beneficiary is not defaulted to the estate. Or if you have death benefits through your pension, it's important that you talk to your HR people and make sure that you've designated a beneficiary if you're able to do so on those benefits. And lastly, multiple wills. And this is really only applicable for those who run their own business, who have private shares. The keynote is private, not publicly traded shares, but private shares in a business. What we can do here in Ontario is we can have multiple wills. One will to deal with your personal assets that you own in your personal name, and another will to deal with your private shares in your corporation, your corporate shares, so that the value in your corporation is not subject to probate tax. Again, it's just the whole purpose behind the multiple wills is to ensure that we're paying less probate tax than we otherwise would. So it's important to ask your estate planning professional lawyer to about multiple wills if you think that your corporation has enough value in it to make that a worthwhile, I guess, cost, because it does cost more to have multiple wills, but in the end, if it saves you hundreds of thousands of dollars, then it's worth it. Now, one key point I want to make about estate planning advice is when there's an estate where the only asset in the estate is a piece of real estate, and so there's no investment accounts, bank accounts, anything else that is really triggering the need for probate. It's just the piece of real estate. It's worthwhile to check to see if that piece of real estate qualifies for what's called or what's referred to as the first dealings exception. I won't get into the backstory of what the first dealings exception is, but any lawyer that works in this field would know what I'm referring to. So if you find yourself um, an estate trustee of such an estate and you're trying to see if probate is avoidable, um, just looking into the first dealings exception, seeing if it qualifies, is definitely um, worthwhile to spend your time and a little bit of money on too, to see if it can save a lot of money later on.